How many times do I have to tell you, if you're not carrying expensive debt, really look at your investment portfolio. 2009 was a great year for stocks. The economy is still struggling, but even 2010 shaped up to be a good year for investors. With low inflation, low interest rates, 2011 could be off to a good start. Are you going to listen this year? Ryan Mack is the president of Optimum Capital Management. Doug Flynn is a certified financial planner with Flynn Zito Capital Management. Doug, let's start with you. What is on your radar for 2011? There's Christine, by the way. Christine, always with us. Doug, what's on your radar for 2011? Let's start with the big picture. Give me winners and losers.
Sure. Well, Happy New Year.
And to you.
Thank you. Realistically, what you have to look at is the word reflation. And that's the Fed saying we want to stay away from deflation. We want to actually inflate everything. And so what happens there is you're going to have pressure on the U.S. dollar. And so the big theme, I think, if you center your investment policy around the following, in addition to stocks, bonds, and commodities, focus in on currencies. That's really where you want to look. Bring currencies into everything you're looking at. The weakening U.S. dollar. You know, the dollar was very volatile this year, but from beginning to the end right now, it really didn't move that much. So you're going to have a continuing weakness of that dollar, and there are opportunities in there. It's not going to be a great year, but there's opportunities if you center around that theme, and that's what we see for 11.
And you're saying, because I got U.S. dollar in the losers, you're talking about other currencies that'll do well against the U.S. dollar?
Right. So if you focus in on, of course, commodities and areas that do well in that area, you've got, everybody wants to center around stocks. If you're focusing on individual stocks, you want to focus in on materials, industrials, technology and energy. Those are related to that. But also anything that you do with commodities, you know, gold and oil and those, you center around, is the U.S. dollar going to weaken and how would I benefit by investing with that? That's the additional tilt you want to take advantage of in 11. That we find opportunity in.
All right, Ryan, let's talk about bonds. In Doug's winners column are high-yield bonds, bonds of companies that might have some risk associated with them and as a result pay a higher interest, which is quite commonplace these days. What should the average investor, my viewer, be looking at in terms of what role bonds play in their portfolio?
Well, again, I think that in 2011, dull is the new black, and it's going to be the new common theme. I think we have to look back at these basic principles. I mean, we had a bull market, we had a bear market. I think this is going to be a moose market. So as opposed to trying to look at what should we do or what should we not do, let's just look at basic principles. What should my asset allocation be? How long am I going to have until my retirement? Yes, bonds did great, but that doesn't mean that you should now put 70% of your portfolio in bonds if you're 25 years old.
Right.
Again, we should look back at basic principles. If you're in that accumulation stage, you're just starting out, you still probably have on a higher percentage in stocks as opposed to bonds for the simple fact that we still have a lot of time. We don't want to have any knee-jerk reactions according to what the market did or didn't do. We're probably going to go sideways for quite some time, but now is the best time, the single best time to do some good dollar cost averaging. I'm still a proponent for individuals who have over 10, 15 years. I mean, if you have less than 10, 15 years to retirement, you might want to have a higher percent allocation in bonds. However, you shouldn't let the market dictate what your asset allocation. You should talk to a good CFP. Talk to someone who knows about, might have an unbiased view and perspective of what your asset allocation should be. Go to a fincalc.com and ask some objective questions about what your own asset allocation should be, and from that point moving forward, look and see what your asset allocation should be.
Doug helped me write my book, Give Me My Money Back. You have just got a new book out, Ryan. It Takes a Village, which I was involved in, and Christine's got a new book out, Smart as the New Rich. Guess what, Christine? In all of our books, we have one thing that we say in common, and that is, don't have this conversation about stocks and mutual funds if you're carrying high-interest credit card debt. If you are carrying debt, your priority has got to be to get that down, because if the market returned 10% in 2011, but you have credit cards that you're paying 18% on, which is the better win, paying your credit card down?
If Ryan says dull is the new black, I say Allie, smart is the new rich, to plug it again, because smart is the new rich for you next year. If you're trying to plow into stocks a year after they've already been going up and you've got double-digit 19% interest, 20%, 29% interest rates on your credit cards, and you're getting 10% in the stock market, that's a really dumb move. So the first thing you have to do is look at that high interest credit card debt and make a dedication to yourself to get that down. Next, and we were just talking about this in the break, this is so incredibly important. Are you maxing out your 401k? Are you going to get the benefit of anything that's happening in the market if you're not maxing out the 401k? We were talking about that that payroll tax holiday, $800 extra in your paycheck if you make $40,000 a year. What are you going to do with it? You've got a little more financial flexibility. Maybe you should be maxing out the 401k and you get the company match. And as Doug pointed out rightly, then there's also the tax benefit of using pre-tax dollars. So all of these are the smart moves that you need to be making in 2011, because we need to be playing. Don't you guys think we need to be playing offense after kind of just hunkering down for so long? Because companies are starting to make money. People who are rich are starting to make money. The rest of us are still scared for the next shoe to drop.
All right, and that's actually a great point to leave this at, because we're going to pick this up in the next block. Christine, Ryan, Doug, stay right there. Those companies that are making all that money that Christine just talked about, will Wall Street's gains be good news for Main Street in 2011? How do you make it good news for you? I'll tell you in a minute, but first, from a coffee stand to a full-blown restaurant, one woman overcame obstacles to achieve small business success. Here is Stephanie Elam. The four people on your screen have all been telling you for the last couple of years to make smart investments, but probably the biggest pushback I get from people is this frustration that Wall Street's gains, and when I say Wall Street, I mean corporate America's gains, have not turned into good news for Main Street. Is that disconnect going to continue in 2011? Christine.
It might. I'm really worried about two Americas here, Allie. I'm worried about people who have money, who are figuring out how to move forward with their money again, people who are in those STEM industries, science, technology, engineering, math, who are finding bidding wars for their talent, kids who are graduating with those degrees who are doing quite well, and then millions of other people who find themselves in an economy that's more 1990 than 2011, and they're left behind. So I'm worried that the economy is not going to grow strongly enough for Main Street to share everything of Wall Street, which is why we all have to really make smart choices about our money.
Ryan?
Well, I mean, I get it. 2004 to 2007, you know, Wall Street flourished while the real wages never did anything, you know. Then again, individuals at home are getting more frustrated because they had to basically bail out for excessive betting on Wall Street. I mean, I get the frustration, but you know what? Frustration never put food on my table. And so what we have to start understanding is that in 2011 and moving forward, as frustrated as we are toward the bank, so for even to the government, the government, what they're doing or not doing, it is only you that makes the decisions in your household, and the personal decision that you make with your finances, that the government doesn't control that, the banks don't control that, you have to control that.
And that, by the way, is a theme of your book. It's a theme of Christine's book, too, that stop worrying about what you think is going on around you. Start worrying about what you can control. And I know you share that view, Doug, but you want people to be very specific about how they control their financial futures.
Sure, it always gets back down to, had you lived below your means during a period of time when you had some extra money, it set you up with a little bit of a cushion should there be a time when you need that, and that's why you have that. Unfortunately, a lot of people were overextended and went too far and got themselves into trouble. But the point is, most people don't have the wherewithal to get out there and start a new business and take advantage of that opportunity. And if you can't do that, that realistically is what the market does for you.
Right.
It's one of the cheapest and easiest ways to tack on to somebody that is trying to make profits.
Right.
And you've got to do it. So I laugh, you know, the two hats. When you're filling up your tank and you're complaining that it's almost $4 a gallon, you know, that's a terrible thing when you're doing it. But then if you own the shares of the stock of the company that you're pumping the oil into, the gas into, you're saying, all right, well, I'm getting it back on the other side.
Right.
So those are the things you have to try to take advantage of.
And that's useful to think about. When you're mad about corporate profits and how much companies are earning, think about the fact that you might, if you were smart, be on the receiving end of that, too. Good advice to end the year on and to start the new year with. Thanks to all of you, and thank you to all of you for joining the conversation this week on Your Money. I'm here every Saturday, 1 p.m. Eastern and 3 p.m. Eastern on Sunday. Also, catch Christine on Your Bottom Line, Saturday mornings at 9:30 a.m. Eastern. Between the two of us, we've got you covered for your financial needs. Stay connected 24/7 on Twitter, at Ali Velshi and at Christine Romans. We read everything you tweet or put on Facebook. Have a great weekend.